Before we get started, I just have to say how fantastic our Symphony Nova Scotia Fusion sessions were over the lunch hour. Thank you to the Symphony, Jamala, and Keontae Beals. Hi, I'm Bob Pelly. I'm the manager for Cape Breton with Invest Nova Scotia. I work with technology creators and founders to help them bring their innovative ideas to the global market. I've worked with hundreds of entrepreneurs to help them to figure out how to de-risk their path to building a business. As a data-driven guy, I look for patterns and share those learnings with clients to help them build milestones and plans to put into action quickly. I'm always keen to support businesses as they work to scale their growth, and I'll leave my email address in the chat if you want to get in touch. Now, it's my pleasure to introduce our growth financing panel hosted by my colleague, Ben McDade. We have a really great lineup of founder panelists ready to fill us in on their experiences raising funds and keeping the momentum for business growth. Over to you, Ben.
Thanks for the intro, Bob. Hi, everyone. Welcome to our second panel of the day. So I'm Ben McDade, investment principal at Invest Nova Scotia, and I'll be the host for the growth financing panel. A little bit about myself. I'm on the team who manages the Nova Scotia First Fund, which is an early stage venture capital fund with 150 million in assets under management and 50 active portfolio companies here in Nova Scotia. To date, we have returned over $120 million to the fund from direct investments that we've made in innovative technology companies. We partner with entrepreneurs who are building high growth companies for international markets. So in our 45-minute session, our growth financing panelists will share their advice and speak from learned experiences on how to best navigate the growth financing landscape. Today, we're joined by our panelists, Darren Gallup, co-founder and CEO of Carbide, Manny Singh, co-founder of Easy Platter, Doug Milburn, co-founder and chairman of Advanced Glazings Limited, Protocase and its spinoff 45 Drives, and Matthew Zamola, Matt, co-founder and CEO of Real Data. I'll now ask our panelists to introduce themselves and companies before we dive into questions. Darren, can you please introduce yourself and tell us about Carbide and your fundraising experience?
Hey everyone, Darren Gallup here, CEO, co-founder at Carbide. We are an information security and data privacy company. We basically help small to medium-sized businesses build an information security program, get through audits, and be able to demonstrate to their customers that they're doing the best they can to secure their data. We're based out of Cape Breton, although we are a remote company with folks spread out pretty much right across the country. We've got about 40 employees, about 200 customers. So far in our journey in this company, when it comes to fundraising, we started with a very small friends and family round just to sort of demonstrate, prove a concept, raise a little bit of money from some government sources. We did a pre-seed, like a formal pre-seed with some small institutional investors and angels a little bit after that. And then we did an institutional equity round as a series seed in 21, which was 4.1 million US dollars, which was co-led by a Canadian and a US VC. We've also leveraged a variety of non-dilutive means, things like ACOA, IRAP, SHRED, different provincial programs, and so forth. Also before that, I ran another company where we raised a couple of $1 million in capital through both equity investments and non-dilutive capital. And before that, I spent about 8 years in the music industry where I did quite a bit of fundraising within non-institutional means and non-dilutive capital, such as grants and funding of that nature. So I've been raising cash for a while.
Thank you, Darren. And over to you, Manny.
Hi, everyone. My name is Mandir Singh, also go by Manny. I am the founder of Easy Platter, and we are a platform where you can book a chef for your meal prep at home. So think of us as the Airbnb, but a platform where you can get a chef to come to your home for your meal prep. Our fundraising journey, we've been up until now, since we incorporated in November of 2020, we've been bootstrapping and leveraging a lot of government grants, non-dilutive funding. And just recently we closed our first angel round. It's a small angel round, but we just recently closed it. So yeah, looking forward to the session.
And Doug.
Hi there. My name's and Doug Milburn. Entrepreneur. I started first company, Advanced Glazings Limited, out of grad school. It was my grad school research, commercialized back in 1996, which makes me kind of an old guy, I think. So raising money. I remember we started on about, I don't know, several $100,000 of the co money and about $100,000 of an equity raise. And that was I had no clue what I was doing at the time. 96, the economy in Atlantic Canada really swam against the current to come back home to Cape Breton. Very unsophisticated economy. It's developed so much since then. Since then, gone on to co-found Protocase and 45 Drives. Raised about 10 million in equity altogether over the years in multiple rounds. COA money, non-dilutive IRAP. I think with all kinds of stuff over a few decades. Where we are right now, companies about 400 employees in the companies. If we stretch at looking at the $100 million mark in revenue, we use bank finance and we'll use a COA when it's around and convenient for all of us these days. So my whole fundraising has changed, but I got lots of experience in the rearview mirror. So maybe get a chance to share something useful with you guys.
Wonderful. Thanks, Doug. Matt.
Yeah, I'm Matt Zamola. I am the co-founder and CEO of Real Data. My background before Real Data was an undergraduate degree in chemical engineering, where I worked in the oil field for a number of years before I went back to school and did a master's degree in computer science. And out of that degree, we founded Real Data, which was about 4 years ago. And we operate in a niche segment in aquaculture, which is land-based fish farming. So you can think of a giant water treatment building with tanks of fish in the middle, and we're growing fish as healthy and as sustainable as possible. And this market itself is pretty small right now, but has massive growth opportunity over the next several years. And the tools that we build are all around artificial intelligence. So feeding fish, weighing fish, understanding how happy and healthy they are. In aquaculture, it's a lot more challenging to accomplish these tasks than traditional agriculture. It's a lot harder to weigh a fish than it is a chicken. It's a lot harder to feed a fish than it is a chicken. So we're attacking these problems with artificial intelligence. And our fundraising story, so we're a 4-year-old company. We did a pre-seed. Well, first we relied heavily off of a lot of pitch competitions, and then we did kind of a syndicate pre-seed round over the period of a year, where we took in, I think, $100,000 at one point, and then $200,000, and then another $200,000. Then about a year later, we did a seed round, which was 2.5 million Canadian, and that was 2 years ago. And then we just closed our Series A at 10.5 million, and our team has grown from just a couple people and 4 years ago to, I think we're over 40 right now.
Very cool. Thanks a lot, Matt, Doug, Manny, and Darren. So we'll jump into questions here. And so you introduced, the different sources of capital, equity, debt, grants, and others. So are there differences in your pitch when speaking with lenders and investors? And explain the strategy you have for each. Let's start with you, Manny.
Yeah, for sure. I would say that there is definitely a lot of money out there. There's lots of opportunities. And in both the cases, there's between lenders and investors, there's a lot of commonalities. Like they would still want to see, as a founder, you have the knowledge about the business and the industry, you have growth potential, and, you actually have a team that can execute. But what really sets them apart and you're changing your pitch is that lenders are looking to get a cash flow positive response. Versus the investors are looking, for hungry founders with really strong unit economics, and with the envision to build a global brand. So if you're looking to pitch to a lender, get into more granular short-term horizons where you can positively and confidently say that you can generate positive cash flow. And then, on the flip side, with the long-term horizon for the massive investors who are looking at a 10x, 20x return. So keeping in those things in mind, I think, you've higher chances of approval.
And Matt, in your experiences, are they similar?
Yeah, I had some notes on this. Like 80% of all of our decks were similar, and then there's kind of the 20% that we tune. But so we are heavily venture capital backed, even from pitch from VC to VC to VC, the decks would change. Their funds, whether or not they're investors, lenders, care about certain things. We've seen ESG investors, we've seen investors that really care about the technology. So in those cases, we tune the decks to what their investment thesis is, and how we have a really good overlap with their thesis and what our company is doing.
Stuff. And Doug, would love to hear your comments.
That thing, tune your deck. Exactly. Everybody's got a different narrative about what the world's all about. If you want to raise venture capital, well, they have a narrative in their industry of what success is to them, and you need to figure out. And I don't say this in any manipulative way. In fact, it's got to be sincere and honest. Otherwise, you're going to get in trouble. Either not close the round, or you will get in trouble down the road. Who are you, and how do you fit into their world, and how do you make them successful? Is the formula. The venture capital story is dramatically different from family and friends, and quite different from angel investors. I'll talk on the equity side here. And they want different things. Talk about sensible angel investors who've run real cash flow positive businesses. You really want to tell them about how you're going to do something that looks like that, because people want to see the world in their likeness. We move to the total other end of the scale, and what we do a lot of now is bank financing. In fact, we just closed a $15 million deal with the bank, actually all about a month ago, and it's not the same story. Do not go tell them what you tell your venture capital people. Well, sorry, even this, don't go to the bank if your story is a venture capital story, okay? And vice versa. Raising money is selling. You're selling an investment or lending opportunity to somebody. Selling is like dating. Good, you can go tell lies and go internet date and put up a picture that's not you and whatever else, and you're gonna pay for it. So figure out who you are, who you match, and then tell the story correctly for them, and just realize what their story and what they need. Look after their needs. Find a deal that matches both of you.
Excellent perspectives. Thank you. A great analogy. So we'll jump into capital needs. So you often hear in the field, raise more than you need. It's a common adage. So what's your advice for modeling how much capital to raise? And Darren, we'll start with you.
Yeah, so this is part science, part art, I think. The downside of raising not enough is that if you run out of money and you haven't hit all your metrics, and everything in the world internally in your business and externally in the world you're operating in doesn't go as planned, then you're in a precarious situation where you have to start getting into things like down rounds or bridge rounds, which are painful. I speak from experience, journeys. Now, on the flip side of things, I don't believe like some people say, raise as much money as you can get. Well, the problem with raising as much money as you can get is that you're either going to take it on dilution, or you're going to take it on the valuation. And, it might seem like the greater valuation you get, the better play, but and in some ways there's some truth to that. But the other side of the coin is that you have to grow into that valuation. So, and if the investor wants a 10x return and your valuation is really, really high, then you have to grow into the metrics required for the 10x return in that particular example. So the way I like to think about it is just sort of factor those points, but think about, like, whatever your plan is, you do want to factor some buffer for misses. Those misses could be misses internally. Maybe you'll hire a VP of a department that doesn't work out to be the actual resource that can deliver on what you need, or maybe the macroeconomic conditions changed. And so you kind of want to figure that out. And what I would recommend on the science part is model out your different scenarios. What happens if you hit target? What happens if you're 80% of target? Things like that. And really just make sure you factor at least for 80% or maybe a bit more. But I'm not a big supporter of take on as much money as you can, because that can actually cause you to be in a situation where you're not going to be able to raise again, and you're going to be into down round situations, and that's not a good point. So I would say look at your plan and factor for some misses, calculate that out, and go out in that market and see what you can get with that
Stuff. Doug.
Yeah, I mean, I 100% agree with everything Darren said, and I'd add on to that Darren's answering. Darren and I have talked about this a lot over time, and Darren's answer is perfect for his context as he builds a building, as he builds an organization, venture capital, and with some exit in mind somewhere along the way. But you got to figure out what you're raising for. We've always said exit in mind for us, but I don't know when. And what we've said is we want to build a organization that's going to be around and going to have staying power and going to generate cash. So all of our businesses right now are solidly net flow positive. One of them just had a big dip over the COVID stuff, but the other ones have been solidly cash flow positive. You build that and you look at it, you raise more money, come along. Darren said buffer. You got to have a buffer in there. But careful about your buffer, careful about your plans, and especially if you buy into the venture capital narrative, which is faster, you got to get the market share. If you want to do that, you really have to go large on it to make that happen. Everybody, I don't see that. I mean, you got to be Silicon Valley and you got to go get $100 million. You got to be able to waste a lot of it. If you want to spend a lot of money, be prepared to waste a lot of that money. I have never seen anybody who can go in, raise way more money than they thought they're going to raise and spend it and do it effectively. Everybody can spend it, especially when you get a venture capital and guy sitting on your board who's saying, yeah, got to hire this, got to hire that, let's hire. I've always looked at that and said, the business, stage by stage, and you get better at what you're doing. You can learn how to spend money. Look at how you spent money last year. What was effective, wasn't effective. Look at your cash flow working its way up. Model the scenarios like Darren says, and just be realistic what you can use. Figure out what you need, model for your downside scenario, and then go sit your ass in a chair. And if getting cash flow has anything to do with your business plans, it doesn't always. There's lots of people who build business to sell to a public entity and skip the whole make a valuable business thing. But if it has anything to do with putting cash flow into it, sit down and focus on that. And don't get distracted by having raised extra money and having to spend extra money and all that kind of stuff. So careful, very, very careful what you do. Focus on your business plan.
Great advice. So now we're gonna, I guess, have you reflect back on when the early days of starting your businesses and friends and family. So some of you here have raised from friends and family. And my question is, were you hesitant to raise from them, or was this motivating to you? And yeah, so we'll start with Darren.
Yeah. So first on the motivating fact, I think that if you need some sort of drastic fear or pain of pissing off your friends and family as a motivating factor to be successful in your business, then I would say focus on fixing up your resume and getting a job. I don't think that's a healthy configuration. I have taken money from friends and family. However, what I think is really important about that is make sure, first of all, that they are investors. In other words, this is not them writing their first check because they want to help their friend. I think that's dangerous. The other one is make sure they can afford to lose it, and make sure that they are really clear about the realities and potentials of losing it. And I would say this even like 5-fold or 10-fold if you're going the venture capital route, because if you're doing a business where you're going to spend most of the money on assets and you're really focused on cash flow positivity very early on, and the risks are likely a lot lower in that type of business. Now you're not going to have that upside potential of that you do have in a fast, rapid venture cap backed world where you could build a business from nothing and take on some VC money and sell it for $100 million in a couple of years. The problem with the high reward potential is the high risk. So if you're going that route, you want to be clear with the people that you're taking the money that you're going that route, and the risks that come with that. Make sure they understand that, and also make sure they understand that if you're going that route, you're not going to be in charge necessarily for the whole journey. So there's going to be a point where investors are going to negotiate board seats, and then next round comes in, and then another board seat, and then you're going to have external people. And at some point, every time you do that funding round, you're likely going to lose some degree of control over the business. You may even be fired or replaced in your CEO role at some point. So, those are just all things to factor. Again, I've taken the money. I've actually taken the money and lost it in my first business. I've taken money from friends. Wasn't an extreme amount of money, but it was what it was. And but I didn't feel as bad as I think I could have, because I was really careful on making sure that what I took was reasonable for what they could afford, that they understood the risks very clearly. I wasn't, feeding them some bullshit about how this business can't fail or any of this kind of stuff, So I think those are the factors, right? Like, and again, like if you got a friend or family member who's writing checks all the time, investing in startups, then they're going to know that. But if it's somebody who's never written that type of check before, take the extra precautionary measures to make sure that it's really clear, and make sure that you believe that that person's the type of person that's not going to, the other thing, and I've seen this from people I know, have taken friends and family money where it's like every family gathering, it's like, so tell me how the business is going over, Christmas dinner. That might not be what you're looking for either. So, just another thing. It's not, I wouldn't say it's a hard no, don't take it, but definitely give it a lot of thought and think about each individual very specifically. Make sure everything's real transparent.
Wonderful advice. Yeah. Manny.
Yeah, for sure. Really good response there. And since we were just in this very similar boat right now, so we did our very new friends and family round or angel round very recently. So we just went through the whole process. So I was a bit backstory was like, I was not very comfortable, taking or raising any money from any investor. I was living in that cocoon that I would just work, we'll work the business, the unit economics are good, everything is profitable. We just go through that strategy. And almost for 14 months since we started working on the company, our goal was to make sure that, this business is becoming profitable. So we started collecting customer feedback. We started understanding the product. We were just in a really proof of concept phase at that point. And then once we started to get all of this information from the customer, our confidence went up. And then recently we were also, after Dragon's Den being on the show, we got a really good response from those guys as well. That, that actually enhanced our confidence further. So with all of these things, taking into account, customers were happy, unit economics are good, and people outside of just, of your friends and family who are always talking good things about you. That was a point when I decided to jump ship, went into it full time myself, took the risk on myself first, and then my confidence was higher. So we have raised money from friends and family. That's the round that I was initially talking about. So, and then that's the one which we are, working on right now. So, it's the confidence goes up. Your journey depends where you are in the stage. Your confidence. So, don't take friends and family money if in case somebody's supporting you right away. Don't take, if the money is right there available for you. Do your due diligence first, tell them about all the risks first. And then once your personal confidence is high, don't paint rosy pictures all the way. Once your confidence is high, then you're at a point, to accept any friends and family.
And so, and I'm mindful of the comments, the questions that are popping in here, and we'll address those later on as they tie into other questions. But so thinking of the lenders and investors that you approach, what are the traits that you seek in each for a good funding partner or investor? And Matt, I'd love to hear your take.
Yeah, as we were going through the process for we learned a lot during our pre-seed to seed, and during our A was completely different. So when we started seeking out investors and partners for that round, we didn't look at we made sure our thesis matched really on market and good for the world, the ESG kind of stuff. So we didn't, in our list of funds, we didn't have any funds that were investors in AI or investors in camera systems. We wanted to make sure that the investors knew the market that we were chasing, and we found that a lot easier to communicate things around aquaculture, because not too many people know aquaculture. And when you mix it with AI, it just becomes a huge education piece. And so that's kind of how we approached our Series A, and we learned a lot from our seed, because basically every AI specific or advanced technology investor passed on us. And then I guess just kind of as you're speaking to the investors, how well do you get along with them? It is a process. So you have a couple meetings with them, you'll go through the data room, you'll have chances are you'll see them in person. For this new round, our investors flew up, we had dinner with them to make sure that everybody liked each other. And at this point, you can kind of see if your visions are aligned and if you believe that you can get along with them really well. And we also did due diligence on our investors as well. So we spoke with the portfolio companies and asked how their experience has been with them. And then if we had other people within our network, again, just doing our own due diligence and background information on the investors. We got really lucky throughout our entire funding round. So from pre-seed, before pre-seed, just those competitions, pre-seed investors was local ones. We had people that were leading that were really, really good to us. And then as we got into seed and Series A, Larson and Amy, S2G Ventures and Buoyant have been just amazing. And as we looked at them with investors as well, look at things like fund length, how much they have in their fund, can they lead the next round, all the mechanics that the traditional VCs have as well. So we made sure we matched on markets, do we like the people, the fund length, can they lead the next round, and we ended up landing with just amazing investors.
Stuff. Doug, and feel free to comment on, I guess, the lending side as well, if that differs.
Yeah, sure. And my own general thing, it's like dating, find compatible people, right? You know, my own experience, our compatibility has been with best has been with angel investors on one side, and then I'd say bank on the other side of it. Really good match. We set out to create a well, I call it high growth. I mean, there's in the, I don't know, in the legends of business, everybody likes to think about the grow at 200% a year stuff and everything else. That stuff's out there and everything else. But then there's the other 99.9% of business. We grow at about 30% a year, and it's a lot when you're the size that we are right now. And we're kind of an in-between place, because we're right at the edge of, you know, well, yeah, I mean, certainly the, you know, the financial record we have for Canadian venture capital world will be pretty good, but they all have dreams of doing the 200% thing. And sort of funny spot. And when we talked to angel investors in this part of the world, we get told a lot of times, they say, no, companies like yours don't grow at 30% a year. Okay. So you need people that can share your vision of what the company is, you know. And what we ended up finding, we had a set of angel investors out of Ontario who happen to run companies that were part of an organization that started off from zero as an innovation, and over a period of about 17 years grew to be $1 billion. And so growth rates sort of like where we are, which is quite the growth rate if you have bricks and mortar involved at all. And it just clicked. And we had similar values. You know, hard work, look after your customer, be sticky with your customers. You need repeat business to come back. And a whole bunch of values we shared. So it's having those shared values. And there's a whole bunch of different values that work in business, not saying mine are better or worse than anybody else's. It's a whole bunch of different approaches to take, but that worked absolutely great. When we get to lenders, banks have worked out well for us in the last, you know, banks, they say they lend you an umbrella on a sunny day, and when it starts raining, they want to take it back, you know, and that's who they are. You realize who they are. And we look at it and I go, but right now, you know, very, very solid net cash flow producer. We don't need money for growth really as such. We could darn near fund it ourselves, but that's a great time to go to a bank. right? And so they work out well, and it's just an easy relationship with them. Find the people that you have an easy relationship. It's about shared values, about who your business is. So that's what makes a great investor. It's all about you. There's no one type of great investor.
And Darren, any, would you like to chime in on this one?
Sorry, I think there's, a lot of good things were covered there. Are they fair, reasonable people? Do you align with them? Because again, these are, Doug made the reference to dating. I'd say this is even more challenging than dating, because when dates don't go well, you just kind of end the relationship. But when you take a big wad of capital and you've spent half of it already and things start going sideways, there's not really a way out. It's like, it's you quit or get fired, or the business sells, the business goes out of business. Those are pretty much the end of the, so they can often be harder relationships to get out of than a marriage. So I think, putting a little bit of due diligence up front there's well worth it. Already mentioned things like motivation, consistency, align with the desired outcome. And that's just one thing I'll say to reiterate, because I see people pitching a pitch contest and they're saying some bullshit desired outcome that's not actually their desired outcome. It's what they're told that the investor wants is a desired. That's dangerous. That's the lies thing where you put, that's like, Doug's analogy about putting the wrong picture on the dating profile. Like, don't create a desired outcome that you think is attractive to an investor. Go the other route and focus on your desired outcome and make sure that you're going down the appropriate investor alignment to align with people who have the desired outcome, because that's the only way you'll create that alliance, and that consistency there. I think that some looking at, if you're going to be raising the next rounds in A, B, C, follow-on capacity is important. Do they have the ability to follow on? Do they have a network where they can bring in additional investors when you're going on to your next rounds? Especially if you're definitely looking at a business in a build process where you're going to do that, that's important. If they want a board seat, I think you want to look at that. Like, what are they going to do for a board seat? Do they actually have operators that are going to put value add board seats, or are they going to play an observer, sort of more of a babysitting board seat, like watching their money versus helping the business grow? And I think that's a thing to look at. I'll tell you one thing I've been super impressed by when I see funds that say, yeah, we want a board seat, but we don't want to sit on the board because we're not the operators that have the experience to do so. So we're going to go out into our network and find somebody really, really valuable and put them on the board. That to me is really cool, because that shows that they're looking to put somebody there. It's not an ego play about, hey, I'm sitting on all these boards. So, board seats are great. And if you have a good board, it can be very impactful and helpful for the business. And so if they're going to put a board seat on, you just want to make sure that that's going to be a value add for the business, a value add for the outcome of the business, not a babysitting role. I think that's something. So yeah, any other value adds, right? Like, some investors can add value. Now, and I don't mean this in any way to VCs. I think every VC talks about how they're smart money and they add value, but I would say it's a minority of that giant list of like thousands of VCs that exist now in the world that actually will bring the value. It's like, can they bring the value, and will they bring the value? Some are amazing in the value. They have strong networks. They might be able to introduce you to customers potentially. They may have talent recruitment capacity to help you in those regards. Again, I mentioned earlier, introducing you to other investors. So if you can think about that, and I put all those things in order, like I look at are they fair, reasonable people as like number one? Are their motivations consistent as number two? Follow-on capacity number three, and this is just my preference or my personal thoughts. The board seat question, and then value I put lower on, because the worst thing is somebody that brings distraction. You want somebody who's going to be helpful in growing the business, that's aligned, and they're out there. So don't settle on the first term sheet.
Love it. Okay. On that note, so you raised about 100 different good points. But you talked about, as let's say things aren't going as planned, right? So big checks and things aren't going as planned. How do you, so after the funds have closed, what advice do you have to help maintain strong relationships with your investors and or lenders after the funds have closed?
Is that for me?
Yeah, that can be for you, Darren. Yeah. And then, we'll start with you.
Communication. That's it. It's communicating and not candy coating it. Be honest and transparent. Share the good news and share the bad news with even greater sense of urgency. You don't want to show up into a board meeting and share bad news there. Share it when you have it. Keep those lines of communication open. That really is the most important item. Be transparent, be honest, and be forthcoming. And if you do that and you've done your due diligence and were successful in getting reasonable people and good investors, then you shouldn't have any problem. It's as simple as that. Now, it's easier said than done, because as humans, we inherently want to share the good news and, you know, kind of hide in the corner and hope the bad news goes away, but it doesn't. It always surfaces, and there's really kicking the can down the hall on bad news is way worse than the bad news itself usually. So that's
certainly better to be forward with it as soon as you can. Matt, anything to add?
Yeah, no, not much. I had one word written down, and it was just transparency for this question. So Darren hit it pretty hard. But at the same time, I think you don't want to like communication and transparency is great, but don't want to be communicating every single day. I don't think it'll just there's kind of a cadence to it, and we found we do a weekly update to the leads on the most recent round. So what went good, what went bad, what happened, send it in an email, or we do have a call with one of them on a weekly basis as well. So it keeps the investors up to date on everything that's happening within the company, and a weekly cadence is pretty quick. So if something does kind of go off the tracks in a week, you don't have to tell them that night if something's wrong, but I think at least for us, that really, really works. Yeah, just transparency, be honest. They are owners of the business, so it's really important to let them know when things are going bad, not just good.
Doug, any similar experiences or
Yeah, I mean, everything you say there, kind of a weekly check-in. I said we just never picked investors who needed that kind of maintenance, which allowed us to put more time into it. But regular, whatever your regular is, if that's what you agreed upon, that's what you do. So that, and then my other thing I add to it, remember what they came for. Right? And I've watched so many companies and was there for a long time, and about maintaining, it's about holding them off. And it's like, go figure out what they came for. If they came for an exit check and you promise them an exit check in a reasonable time frame, you should damn well deliver it, right? And if they came for dividends, you should deliver it. And I'm now lucky enough to be at a stage in the business right now where we, a bunch of our people have first round investors, and Protocase who put in about 20 cents a share. They got $1 dividend check this year, and they've been doing that for, getting a decade, not that big, but they've been getting more than they put in every year. And you put a smile on their face, and something strange happens when you do that. They don't come to the shareholder meeting anymore. You think they come to it because of all the excitement, and they actually don't show up anymore. If they're there with you, it's because they're not comfortable, right? And if they're not comfortable, there's a good reason. If it's a young business, we're always tenuous when we're young. You promised exits, good. Promise an exit. Keep that in mind. It's just so easy to lose that and go into that. Yeah, follow on round, and whatever else. I look at it and go, yeah, promise an investor. Careful what you promise them. Get some reality. It's hard because when you come into entrepreneuring, when you're new at it, You don't have the experience under your belt. But get as realistic as you can about what you're going to deliver, and then deliver it. And the more you deliver it, the more comfortable they are and the less maintenance they need.
Going to take a step back in the sequence of fundraising, but as you're preparing to raise your round, what advice do you have for the folks in the audience, the business operators and founders, in terms of how they can best streamline the fundraising process? And think of in terms of data room and other, I think that would be some interesting information for the audience to hear. So Mandir, let's start with you.
Yeah, for sure. So we're looking at, when we were sort of in our first round, we started to track metrics early on, like what are KPIs. We started to build a dashboard, and not knowing that eventually we would need it for a data room, but just trying to track our own KPIs. That was one of the things that we really focused on. I also noticed that talking to other founders in the similar stage, like when they were raising, you always had this in the back of the mind, like, are we missing out on something? Is this a fundraising race? Like we need to be involved, and what do we need to do? So what we started to do was, understanding what those metrics are. We also started to look at when is the time when we actually need the money. So rather than focusing on building this huge deal of raising the money, we started to focus on, all right, this is where we are at right now. This is where we'll run out, sort of do the back calculation from that. And then understand, like, this is where we need to be. So having your data room in place was very easy for us to set up altogether, because we were already adding all of those things together. And you can there's many podcast books outside where you can figure out what goes in a data room. But sort of our focus was always on getting information from customers as to what they are feeling when they're using our product, capturing all of that, getting the information about from our chefs as well. How are they feeling? And then you have a story to tell, fix your product, make sure that you have a good product market fit, and then go back. And then you have a full picture about what you're doing for the fundraising process. So I would say, being focused on your business all day, every day is sort of, is the key. And the whole fundraising cycle, treat it as almost like a project. Get in, get out, keep it at the back of your mind, get warm intros whenever you can, but treat it like a project, do in and out, and you have all of the data anyway, which is secured for you.
Darren, you want to speak to your experiences in this?
Yeah. So, one thing I'll just say is that as you go up into like your A or B, as you get into bigger rounds and your business has some more maturity, the process gets a little heavier, because when you're going in and doing a pre-seed round and you don't really have many metrics, it's really about you, the opportunity, the vision. And that becomes more storytelling. So your data room is a little lighter, and building it out is a little less work. When you've got 6 years of traction behind you, and you've got churn and renewal and upsell, and you've got all these things, then those investors are going to look through that, and they're going to spend more time in that due diligence. So a data room becomes a bigger project. The thing I would say is get organized before you start, so you can run at a high velocity. Don't go out and start trying to raise money if you don't have your shit together. So figure out what it is and the degree of sophistication that you need. When I say get your shit together, what that looks like, that it's aligned with the amount of money you're raising and the sophistication of the business or complexity of the business. So building that strong plan with the supporting collateral. I like having my forecasts at least 24 months, nice and clear, real good granularity, bottoms up, not top down. So not like, hey, 3x year over year growth, blah, 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 but like actually being able to go back into the depths when somebody asks you the question and show that you've been thoughtful and methodological about how you're going to actually hit certain targets, versus just telling them what they want to hear, which is the 2x or 3x growth or whatever that is. So getting that together is important. Get your email templates, your presentation deck. I like to have a presentation deck and an email teaser deck, a little more verbose, because you're not there to talk about it. I don't like having a bunch of words on a slide deck when I'm talking, because then you got this dual brain distraction going on where somebody's trying to read your shit while you're saying it, and it just kind of like isn't as engaging. So, get these things sorted, build the data room, make sure it meets the requirements. If you're going into a Series A or a Series B, you probably already have other investors, so lean on them. And that's where they're going to, even if they don't know how to run a business that well, they're going to know how to run a funding process. They're going to know how to run. They're going to know very well the financial metrics that they want to see and what the level of sophistication of the data room is. So this is an opportunity to lean on your investors and get help in that point. I also like to get a sense of what are my tier ones and what are my tier twos. So like, best case scenario, what are the 5, 6, 7, 10, 20 investors that are so dialed in my space that could actually bring real big visibility or really big value to the business. And that's where I start my energy to see if I can get one of those to drop a term sheet. If not, then I kind of go down the list into like, okay, well, if I can't get what I want, what can I get? And, go to there. If you're going to be if you're going to be going on a big process, You know, you hear sometimes people talk to 50, 60, 100 people and raising around. Get a CRM together or some sort of whatever the best way you can get organized so that you're going to be able to follow it. So that's a really big one in there. Yeah, that's the big part, really. I know that we're kind of coming tight on time here, so I'll cut it there. But those are some real big things. Get super organized and get your collateral together so you can run a fast process.
Wonderful. So we 1000% agree. You know, you really want to automate as much as you can to allow you to build your company, right? So I'd love to thank Doug, Darren, Manny, and Matt for the wonderful input. Super helpful stuff that's under the hood that's not talked about all the time. Also, our audience, there were some questions we didn't get to. Thank you. Feel free to email me and maybe we can follow up with you on some of those around signals for follow-on investors and what they look for. So again, you know, that's it for this session. You know, you're going to be joining after a quick break. You'll be back for the afternoon session. So thanks again, everyone, and all the best.
Thanks.
Thanks, everyone.